needless to say, yes, fintech funding is down. I've just written a piece on Q1 data for fintech, and in Europe, funding was down 83% on this time last year. Obviously, this time last year, we still have that whole hangover from 2022, where things were just absolutely insane. But I think what was really interesting within that data was that climate tech and deep tech have both overtaken fintech. So my big question to investors was like, ooh, is AI the new fintech? You know, am I out of a job? I think what's interesting now to look at is the subsectors within fintech, which ones investors think have more viable business models in the period that we're going into, and also how long we think that's going to last. So I guess first off, yeah, diving back into that data, payments, which is usually like the favorite subsector, and also banking, they've now been overtaken by mortgages and lending, and also financial management solutions, what I like to call CFO tools, which might not be much of a surprise given all the things that happened in Q1. So I wanted to ask, who should I start with? David, does all this data surprise you? Do you think we're a bit sort of slow on the uptake there with the data? And what do you think about sort of fintech's old favorite subsectors being overtaken?
I always struggle to think that these data points are really a perfect image of what's going on. I think for my personal investing approach and world, nothing really has changed much, and it's the same thing. You know, you look for pretty groundbreaking things, transformational things, things that get changed through software, things that weave in Gen AI or anything else, and you know, open up asset classes to people, payments. So it really hasn't really materially changed anything for me. I think it's probably a snapshot that's misleading if you only single-handedly took this one, but you'd rather wait a bit more and look at, you know, more, say, comprehensive set of data across years and stuff to really see what's going on. That's my take. I mean, I'm speaking for us as an investment house. I think really the fundamental strategy hasn't changed at all. We look for similar set of companies, type of founders, opportunities, you know, worlds being changed through the, you know, technology being woven in and stuff. So it's not really, I don't really see much changing other than the fact that we are in a cyclical downswing. We have a correction in front of us or in the middle of it. I think that's normal and something to be expected in the market economy. At least historically, it's always been, and you know, that's probably the aspect I should be most mindful of.
Nina, you're nodding away there. I'm interested to hear your take on that.
No, I fully agree with David, and I also think it's really impacted by those growth rounds, those mega rounds that didn't come as much in those sectors over the past quarter. I also found the number shocking in the beginning, but then I think you also described that in the article that it's mostly driven by those mega rounds. And in the early stage, we do see lots of activity in payments, I'd say, and also like new companies evolving in the space that are quite innovative again. So it's always those evolution cycles, I'd say.
And I guess, yeah, exactly that. I'm noticing within payments, certainly the pitches that I'm getting are more, what should I say, like in the weeds payments. So it's not the sort of big glitzy payments managers that we've seen in the past, but it's often problems within payments that only people that have worked within payments understand. That's what I'm seeing at the moment.
Yes, and I'd say through the whole open banking category, you now have those players that really cut all the intermediaries. So you have true innovation, in my view, with those account-to-account schemes that cut all the card intermediaries and therefore also lots of costs. And you now see this being adopted in both e-commerce but also offline transactions. So I think, yeah, it's a new kind of category that really arose. Yeah.
So there's still hundreds of potential startups in that space.
I think so.
Mark, I was interested to ask you sort of a similar question, but obviously the funds that you're working with, am I right in thinking that quite a few of them have been founded themselves by founders or ex-founders or serial founders? And so when we're talking about these, what should I say, old school fintech subsectors like, as in the OG subsectors like payments, are you seeing those founders focus, again, more on the problems that they discovered maybe with their own startup, and now they're wanting to invest in a new generation now?
I hope this works. Certainly, we do see founders and former operators start new venture firms. Give you an example, Discovery Ventures, the founders of SumUp here in Berlin, or not far away from here, I suppose. We're in Hamburg today. They set out to institutionalize their angel investing while maintaining a rather nimble approach and entering financing rounds very early still, and haven't taken the leap into the Series A camp where it's very competitive, and we tend to like that. These are also relatively small funds, typically in the double-digit millions, not triple-digit millions. And maybe to zoom out a little bit, when we started Equation about 3 years ago, we looked a lot at different types of sectors to invest in, and actually fintech wasn't our favorite bucket, to be very honest. And I know this may not be the welcoming news here in this audience, but at the time it was very overvalued, and you saw a lot of problems on the horizon. So we shifted our attention early to climate tech, deep tech, health and biotech, and in a way we selected the funds according to that thesis. So that means we have, to the exception maybe of Discovery and a few others, a relatively small portion of fintech, but there is still enormous opportunity in this sector, especially now that the valuations have come down. But there was a lot of irrationality, especially in later stage rounds, and it basically made no sense for us to become active in Series A onward type of financing. But now it actually has come down quite a bit, and I see a lot of promising funds as well as entrepreneurial talent going after these opportunities.
So do you think that maybe we're going to see an entrance into fintech investing by some funds that hadn't done that ever before, because things have got less crazy and because it was such a sort of insiders club for those with loads of cash for a while?
I think if I was over the weekend, I had the great benefit of visiting Omaha, Nebraska, to go to the Berkshire Hathaway meeting, and basically it's a completely different world. It's all about value investing, and there they speak a lot about beta and the way that the market basically trends up. And in the last, let's say, prior to 21, you could pick any sector and you would have made money, whether it was real estate or within finance, in VC, picking especially fintech, which was sort of ones and zeros put into business. You were really benefiting from a great market environment. Now the landscape has changed, and raising an emerging manager fund right now, meaning a new vehicle in the first, second, or third fund generation, is incredibly tough unless you're very skilled and knowledgeable about that specific industry you're operating in. So I'm hard-pressed to see that this will succeed by some team that is nascent to the industry, with specialized teams, and the generalists like Index or others who have shown that they can do it historically, they will remain on the receiving end, I suppose, and they will continue to fund this innovation. But I'm very much after teams that are extremely focused and have a strong individual background, whether it's angels, operators, or former VCs who know the sector.
Cool. I'll come back to sort of that specialism, especially within founders, later on. But Jess, I really, really wanted to ask you, because we actually had a brief email exchange about it a few weeks ago, but given that what I've just said about CFO tools, financial management solutions, being incredibly hot, and it's certainly showing up in the data, really wanted to ask you about your own pivot, because when we spoke for your pre-seed last summer, you are launching crypto API, and now I understand you've moved to treasury management. So I'd love to know, why?
Yeah, I think there's always these two perspectives. One where you look from the customer or from like bottom up, and then you have like the market perspective, top down. And the funny story is, like, when we started, we actually had on our initial pitch deck something like treasury as a service written. And then we took this whole detour over crypto, because we still, I do still believe that we could have built this really nice with on new financial rails, make the whole banking experience more efficient. And we just got a bit, I would say, lost in this whole side. However, what we saw is that building an early stage company, you can have like a nice technology, a nice idea, a business model in which like a lot of VCs believe in. So we got like our pre-seed round, which was like very high, like 2.8 million back then. So we really had the potential to build and keep going on that side, but we just didn't feel the pull in the market. So with every customer call we had, with every demo, with every conversation, we just felt it's like going lower, and there was now like, you know, this strong pull. And then we started to interview all our customers and ask them, like, what else is there that you would actually need, and what else would you actually buy? What should we build for you? And a lot of them were like pointing towards this treasury tool, that they have multiple bank accounts, they don't know how to manage it. Some have it only on one bank account, they don't know how to diversify. And then I think the interesting part is this like shock moment. So when the Silicon Valley Bank event happened, it was such a trigger to the market that we really saw even stronger demand. And I think that's also one explanation, that there are sometimes topics that are hot because there are triggers that really point this out. And then one question that probably VCs, but also founder ask themselves, why should I build this now? And then you have the answer to that.
So incredibly, my understanding is that you'd actually sort of gone more down this avenue before SVB, and then that was quite good. I don't want to call it good in any way, shape or form, but good timing for you. But also thinking of those big market moving events that sort of influence the direction of everyone's thinking, what about the year or like the 18 months now that crypto has had? Was that affecting sort of the fintechs you were working with, or the companies you're working with, their desire to move into crypto? Was it making them more nervous, especially whilst they're trying to like manage their own runway, as you know, in terms of places to invest?
Yeah, I mean, in our case, we were actually selling crypto APIs to companies that were not yet in crypto, so it was fintechs and banks. And I mean, they are like the first one also to stop going into this like market when there's more risk involved. So it was very, very hard to sell to somebody who's not yet convinced, right? Especially in times that there's more, I would say, trust shocks happening.
But I'm interested to talk a bit more about crypto and Web3, especially seeing as it's in the title of this talk. Because I guess like when I'm talking to investors, quite a few say that the first generation of fintech hasn't really done anything new, and that it's sort of old financial systems in more user-friendly packaging. When you're talking about long-term, and especially David, when you at the beginning when you said, you know, your investment thesis hasn't really changed and things like this, and Jess is mentioning like VC desire for crypto. What did like FTX and things like that do to your thesis on crypto? Has it changed at all in terms of, I mean, crypto is a huge sector in itself, as is Web3. So are there sort of subsectors within it that you're more interested in right now and that you think have sort of more fail-safe business models to be backing at early stage?
Yeah, good question. Same answer, not much. So it really hasn't done that much. Why? Because you know, we think of crypto as a technological underpinning for a novel product solution, and I frankly never really cared what the technology underpinning is. It just happened to be one on, you know, a decentralized architecture with logical centralization that's running a system of information transmission. You know, that's novel, that's really cool, but I looked at the end product. What really is the service delivered to a customer or user of it, and I deployed accordingly. So I really had no orthodoxy around wanting to deploy in crypto anything. I believe that some fields of it are really relevant, and you know, that's a bell that's very hard to unring, because this will just not go away, because it has some inherent advantages around consensus building and, you know, the transmission of information. And you know, we use this and then think about, okay, what type of novel product can emerge that's actually useful for the world on an architecture like this? Now you arrive at some, but certainly not all of them. So I'm highly critical of the part of the industry that's, say less value accretive to the world, and largely around making money on a short flip. I'm more liking this part of the universe that really creates something new, be it file storage on a centralized basis, novel forms of ownership like NFTs that are interesting for some parts of the market, or consensus building around financial transactions. If you think around the DLT world, or so anything that's the less flashy part of financial technologies that are around, how can I actually effectively remove a central entity of that value chain in a trusted way, and how can I create something really new with this because I'm removing that type of entity, be it in financial settlements and others. So that's really interesting. I think there's a case to be made for crypto, meaning decentralized consensus forming, to make a dent, and this will probably happen in the long term. There's other forms like sending money or any forms of information in certain use cases where it will certainly stay and will make a real dent on the universe. And there's another part of that world that's just rubbish and noise and largely unnecessary. And unfortunately, those attract the headlines and stuff. So the bottom line is for us, nothing changed. It's the same perspective. It's the same thinking around technology as a way to a certain goal, meaning a novel product, a novel solution that's really needed and important for the world.
And again, Nina, I wanted to ask you about this because especially at early stage, I was interested in whether you're seeing as many crypto companies come to you as you were like a year ago or so. And if so, again, within crypto, what are they doing? Are they sort of serving banks? Are they focusing on more stablecoin side of things? They not B2C, like the trading stuff, I guess, really not au fait at the moment. But yeah, what are you seeing?
Yeah, I agree with David that the whole innovation is coming in cycles. So you do see those topics again and again. And of course, if the hype is there, you see more. But it's important to cut through the noise and then identify the opportunities that have lasting potential and where we believe in the ground technology. At the moment, we see a lot in infrastructure more than on the consumer side. And this is good and bad. I think in both areas you can innovate and also find lasting technologies. One topic that's quite interesting right now is, for instance, moving all the know your customer and compliance technology also in the Web3. So it's not so crypto related, but Web3. And so there are always those trend topics, but it's important to look at every individual company and not be so much moved around by trends.
I think it's a general problem to pick this up because when you think about the interplay of press and the general public and technology and these type of hype cycles of be it Gen AI now or crypto the wave before, they're always driven by global phenomena, right? The idea that everything is decentralized in the world and fuck central banks and they're all going to go away, and I believe in anarchy in the financial or monetary system, and then people say derive conclusions that the entire world will change, whereas company building and also the necessity of a company in a space is driven by a local problem. Do I actually create something that's really needed, that's technologically feasible, that I can actually bring to the world and bring to market in a reasonable amount of time, and that people pay for? So if you take these type of 4 simple points of analysis, I think you really very quickly end up with thinking about the most relevant stuff, no matter what phase and hype you're in. And I think that's probably the biggest takeaway for me and also for people that we discuss this with, to really see through and think about, is it really a problem that's being solved? Can someone pay for it? Will it last? And cut out all the other stuff. And that's quite difficult because I think the general debate always looks for flashy macro problems and macro waves and things that are ultimately changed by one single set of solutions or technologies, which is never the case.
But of course, there's a bit of lack of trust for consumers right now, so it's important to also make sure you have this product market fit and can't build for years without showing traction.
But I also think, if you raise your first round as a company and then you have to kind of prove product market fit, exactly what you said, you have to show that you find the right customer in a reasonable amount of time, so maybe 1.5 years. You find like a business model that makes you money. Best case, your unit economics makes sense, and demand is like going up. And I think if it's a topic that nobody on a macro level is interested on a consumer or on the business side, it's just very, very hard to build this out. So obviously the whole industry is a bit driven by trends and by cycles and by hype.
For sure. And then there's also, factors like the closer you are to interest rates affecting your business model and things like this. We've seen, for example, revenue-based financing was like super, super hot when I started reporting for Sifted. It was like anything we wrote about those kind of companies was read so much. Now, whenever I speak to a lot of investors and I say, which subsector are you steering clear of right now, that one comes up. So there is this question of what business models can weather those macro trends. It's not just a question of hype and trends, it's actually like fundamental business models. In terms of, what people are willing to pay for, I thought that was quite interesting in terms of your actual model for payment. So for example, we're looking at lots of SaaS companies cropping up at the moment. Again, I'm seeing a lot of serial founders who are now like targeting a problem that they found with their first company, with the SaaS company. But then I'm also hearing from other companies that there's quite a few of those SaaS subscriptions that they're getting rid of right now as they try and figure things out. So this is a bit of a general question, but I wanted to ask, I'll go for you, Mark, first, but like, what are people willing to pay for right now? Is it stuff that will save them money, or is it stuff that's going to feed into their like long-term goal? What's worth it?
That is a rather broad question. Let me try and tackle it from a slightly different angle. I think people are willing to pay for something that solves a need or a problem. Yeah? If you have a problem, you're going to pay for it. And let's not just talk about people. There's basically three buying entities in our world. There's the state, public sector, there is companies, B2B, and then there's a consumer. Yeah? And on all these three, and the state has been overlooked for a long time, and in Germany we're implementing hopefully some legislation soon that makes it easier for startups also to sell to public institutions. Whenever you solve a problem that is big enough, and it could just be entertainment, to say something silly, Candy Crush or what have you, it is a better use of your time seemingly, or at least one which people are willing to engage. But on a more, let's say, substantial or meaningful level, curing cancer with the use of artificial intelligence or finding pharmaceutical breakthroughs with that technology can actually be very meaningful. And both the state and pharma companies, for example, have a keen interest in doing so. And certainly people are willing to pay for a decent financial service as well. And I find, going back to the roots, a little bit like David has alluded to, asking yourself where's an actual practical need, where is maybe a detrimental consequence of our society, the way we organize businesses and the planet, speaking about climate change, you will see more and more VCs going after these sectors again. So again, in a way, 50, 60 years back, when VC was about semiconductors and defense, I think there's a push towards more fundamental problem solving, and there will be a willingness to pay. And where there isn't immediately, because the upfront cost is so high, there will be state subsidies kicking in. Also in a more broader geopolitical context now, with a race for superiority among mainly US and China and Europe as a bystander. So I think ultimately it boils down to what is useful and what is actually solving a problem. And VCs and founders who can invest/operate in this environment will certainly make very decent returns ultimately with strong unit economics. But it very much depends on the model, on the industry, the stage, the geography. So I unfortunately can't give a holistic answer.
No worries. That was still really useful, and it sort of brought a lot of other questions into my mind, because I guess another general big picture question here, but riffing off what you're saying, do you think that in a downturn it makes everyone think more long term? Do you think that in sort of 2021 we were just thinking about short-term gains and winning thousands of customers on your neobanking app, but we'd sort of lost sight of like how you could maybe think about making your customers invest in green stocks or I don't know. I'm sort of thinking on my feet here, but do you think the market sort of correction is making investors step back and think a little bit more big picture about
Yeah, I think part of the slowdown of the recent funding that you track, right, and you write about, is about this lack of fundamental proof. And there used to be a proxy for fundamental proof, which was adoption or hype or media mentions or user growth. And now we need more fundamentals, and these take time to develop. And until there's a lot of dry powder in the market, let's not ridicule ourselves. These funds are still filled up to the brim and they can still invest. But they don't right now because they're hesitant. They know that their LPs are going to slow down because the markets are off. They need to deploy much slower. So what do? They go for quality. Quality, what is the easiest way to measure quality? It's decent unit economics, actual revenue. Bottom line not so important, but at least the unit economics need to work on a single unit basis. And that was not the case for a long time. Actually, for the entirety of my VC career, when I was a direct investor, pretty much, at least for the second half of the decade, it didn't matter, yeah, and almost didn't matter. Let's say that, yeah. So it was much more about vision and other proxies for fundamentals, and now it's back to fundamentals. Hence, I mentioned these rather old-fashioned folks in Omaha. They look at the businesses in an entirely different fashion. And there will be another component, though, and that's a thought that maybe reaches a bit further beyond the financial metrics. The viability of a business. I mean, I don't speak about ESG, actually. I speak about more the secondary effects of a company and the technology it builds. That will come into play as well. We will have, at one point, maybe a separate balance sheet for not only the financial side of things and the way the company is funded, but rather what kind of impact it has. And I think that is something which is often overlooked and will creep into the behavior of investors very soon, or is already there, in my opinion.
Nina, do you think this is why we're seeing climate fintech funding go up? This sort of, investors thinking about, how can we merge or make ourselves feel a little bit better about our fintech investments, perhaps?
Yeah, good question. I think it's a category that is super interesting, and lots of people have built own teams just looking into climate tech like we did. We invested more into the energy space and more classic climate tech than climate fintech so far. But this might change, and I think it's a category where lots of consumers, but also companies seek solutions, and that's why products are being built. So it's definitely a hot space, yeah.
It's also one that's a bit more removed from fundamentals, as Mark pointed out, at this space. So I think, the creativity of allocators is boundless. So the moment they get hit hard in portfolios around fundamentals and the idea what a real price is for the stuff they bought very expensive in 2021, they look for new spaces. So that probably explains one of these things as well. It's a space at this point still largely removed from the idea what a fundamentally successful company could look like, because the pots of money that drive into it are, a little bit more idealistic and less commercial. This will change as well, but that's why you see a trend in this direction too. And you always see this flame up in moments like those. People need to go somewhere and do something. If they don't do it in their main portfolio, they look for other stuff. So it's a bit of a cynical view, but it's probably really true.
I like it. And also, Mark mentioned, record amounts of dry powder right now. And then the words ESG, again, in the title of this talk, crept into the conversation. Are your LPs, do you have LPs that are sort of give you quotas for the ESG credentials of your investments? At Sifted, we're quite interested in how that's sort of seeping through into early stage investments right now, especially in terms of the life cycle of the funds that we're looking at and sort of towards the end. I don't know, devil's advocate here, is that affecting why we're seeing more of these sort of more planet-friendly startups being backed?
We don't. Our LPs don't. We maintain a purely commercial angle. It might overlap. Don't get me wrong. I think that ESG as a topic is relevant. I think there's a massive market to be had around this, but we think about this commercially, right? So ultimately, my only and main driver is the idea: can I really help create a transformational business that's standalone, that can IPO whatever it does, and generate a lot of money? That's the ultimate driving force and the incentive we have. But yes, there are a lot of LP euros or dollars going into that field with different criteria attached. That's why you see a lot of funds being raised, surprisingly many funds being raised by surprisingly many teams in this world of ESG, whatever it means, and also a lot of startups funded. Yes, that's obvious, and that's, you know, it's just a secular wave, just as others have been before. I think we've been in this wave before, also with green tech and clean tech. Now it's different because we realize how urgent it is. It probably is a lot, will mean a lot of euros being wasted and dollars, because those are fundamentally not viable business models that can stand alone, but some of it might trickle through and, you know, stay and really build large companies. So, yeah.
Yeah, maybe to add, I agree. So you have those impact funds, but also the traditional VCs like us that just see it as a commercial opportunity. I mean, personally, we also like the visions, but it's also just a business opportunity to invest in the category. And then, of course, what our LPs expect is a much more diligent reporting on our companies, and that our portfolio companies are run in a ESG compliant matter. So that's absolutely requested. But this positive impact in every investment isn't something that our LPs require yet.
Got it. Interesting. And yeah, the other sort of long-term problem that I thought might be interesting to discuss is productivity and sort of the productivity crisis. I mean, it's particularly bad in the UK. But obviously, AI has a major part to play in that. And it's really interesting talking about AI within, you know, when we're talking about fintech, you know, whether AI actually has any like really amazing impact within fintech yet, or like what the potential is there. So I was just quite interested to ask, yeah, everyone here really, because also Jess, you're an investor yourself. Like, what do you think about AI's potential within fintech, and do you think that we've really like cracked where it can be useful, other than sort of like wealth manager bots and things like this? Because clearly the fintechs on the market right now who are having to do lots and lots of layoffs have a bit of a productivity crisis themselves. What could AI do to help that in the future?
Yeah, I think we're still at the very beginning and yet to see what's coming there. For me, on the one hand, as a founder, like, so when we interview people, we actually also ask them how they're using AI in a day-to-day, you know, scenario, or we give them a case study and then ask them, did you use like an AI to kind of answer the case study? And I think if somebody would say no, it's actually even a bad sign, right? Because it should be something that you're using on a day-to-day basis, at least to get like a high-level overview of a certain topic very fast. Because I think one of the skills you have to have working in a startup at early stage is to understand a problem super fast, build your own opinion with the information you have, and then just act also fast on it. So I think from that perspective, it's definitely kind of infiltrating the whole life of a small team that has to work on like a certain set of resources. From a kind of investor perspective, like the kind of decks I get on AI, I'm a bit hesitant because I have to admit that I don't fully yet understand it. And I'm a bit, I think you have to at least go down that rabbit hole to understand what's the difference there. Is it only a hype? Are they just using the same API that ChatGPT gives out and they just put a different front end on it? So for me, it's quite hard to judge. And I think I would leave that for now to people who really got down deep into that topic to invest, while I focus on the topics that I understand that are more like fintech, B2B, SaaS. Yeah.
Yeah, that's really interesting because again, yeah, recently I've just been throwing out these like silly questions to VCs and seeing what they're saying, but I've been asking everyone, is AI the new fintech? Simply because there's just so much more money going into it, and this has been the answer, like from everyone, is that no, it's so complex, you have to have such specialist knowledge. But that kind of reminds me quite a lot of crypto, because I think that we did see quite a lot of fintech investors or generalist fintech investors who didn't truly understand what they were investing in some of the time. And so there is always that danger as well.
Totally. And the other question is, what does it actually mean? So where is value being accrued in AI as much as in crypto? So just because a set of technologies is relevant and generates a better outcome doesn't necessarily mean that you can build standalone companies around it. that last. Again, they stand the test of time, they produce unit economics, people pay for them, and they can defend themselves against competition. So that's the major question that we're toying with right now. How can you really design or see through that stack and understand what is it material for a standalone company? Is it just a product? Is it just a product component? Where does it feed in? Who accrues which value at what level of the stack? Like the typical questions of analysis, and they're not too dissimilar from what happened in crypto in 2017 when people were dividing all these stacks and decided, it's either the so-called primitives, meaning computing or storage, that accrue most value, or the end solutions and the dApps. That's, I think, the most relevant point, and we're not there yet to really identify that, because it's a hugely moving and fastly moving world, and a lot of it is moving by open source as well. So you have decentralized communities below it that operate at lightning speed, if you will, and might change one thing overnight. And so it's quite hard to answer at this point for any generalist or even specialist VC.
Yeah, but I still think it's such a groundbreaking technology that especially European ecosystem should really look into it and be part of the evolution. And we have the 2 people now specializing into it, have one investment in Aleph Alpha, it's an infrastructure company in the space in generative AI. And of course, on the application layer side, I think there's a lot of uncertainty still, but so in my opinion, it's super crucial that we are also part of the wave.
I would like to add another thought on how to bundle good social causes with making money. For me, financial services is about allocation of money, ideally efficient allocation of money. And if you try to get a loan as a startup business, a sole entrepreneur, or somebody who doesn't have a lot of track record as an individual paying back the money that has been lent to him or her, it's really challenging, even in Western society. We have to figure out systems that do pattern recognition and allocate money to the folks who actually are willing and able to pay back. This is just a very simple, almost like, I find it more simple application of AI. But think about customer relationships, think about the way that you interact with your bank, the kind of stuff that they send to your inbox that is oftentimes irrelevant, which they could do better on. So even on the distribution side, there's so much to be done. So there will be a tremendous innovation and a leapfrog in efficiency. But I think you cannot compare, frankly, AI and fintech as a sector, because AI as itself, for me, is a horizontal technology that spans across various industries and could be applied as much in pharmaceutical research as in getting better services delivered to a smartphone app that happens to be your bank account.
Yeah, really, really interesting. Certainly from a journalist perspective at the moment, a lot of pictures I'm getting are startups or fintechs that are sort of front-loading the AI factor, and then when you actually ask them what they're doing, it's like, yeah, a tiny bit of sort of back
There's a meme out that all the crypto guys from 2019 are now AI guys. So those were the advertising technology guys before, and the social media guys. So I think those come in hype waves. They always need to find a home. Probably you'll see Gen AI conferences in Miami very soon, because they also popped up for crypto. I think it's the normal wave of hype.
And then all the sports events will start being sponsored by them, and yeah. Okay, I guess lastly, it'd be really fun to ask everyone what the fintech subsectors are that you are most excited about right now, sort of going forward. So in the next few months, that you think have the business models that are really well set for the sort of market that we're in for goodness knows how long, like the next year, 2 years. And then the subsectors that you're steering clear of right now because you think that they don't work within the macro environment. So, David first.
I don't steer clear of any sector. I'm surprised because they all have pockets of really interesting stuff that might build transformational companies that last. I'm most interested probably in second-level fintech stuff, so fintech components that get woven into consumer platforms or enterprise platforms, SaaS platforms, retail platforms, because ultimately one of the bigger secular trends is that those will eventually become financial players as well, or whatever it is. And you see this very clearly in enterprise SaaS, where say transaction monitoring or transaction enablement has always been a core value driver. If you think about the Shopifys or the Toasts of this world, that's stuff that's super interesting because you see it in a lot of those classic traditional cloud software companies, but then also on the retail end or the consumer end, where can we have financial components being offered as an adjacent service or as a product line of an existing aggregator? I'm an investor in Grover. Grover is ultimately a retail platform, but might also be a financial services platform. So we think a lot about this stuff. Those things are really interesting to me because they use an existing base and then make something financially happen that maybe solves a problem.
Yeah, I wouldn't steer any sector as well. I think there are always exciting new evolutions, but trends that I really like is open finance, so the evolution from open banking to now open insurance, open wealth, so really opening up data sets and enabling this embedded finance trend that David also mentioned. And then, embedded finance, I also strongly believe in. We did 2 investments there recently, and I just think this also solves a lot of the cash efficiency problem of the customer acquisition costs of other traditional players. Yeah, so two topics.
Really interesting. Jess?
What I find very interesting is software or like technology that was previously only available to very big corporates, and then kind of using technology or digitization in general to make it accessible to like a new group, like SMEs or something in between, and kind of transferring what was very complex with kind of the technology and the kind of different pieces you have into a new customer segment. So that's something I find also in fintech very interesting.
I'll close out by uttering my fascination for the development of private markets. So if you think about the way that data is being processed in public markets, it's very efficient due to the reporting requirements that stock corporations, bond emission houses have. And we don't have that same transparency and access to data, but that we have novel ways in which to retrieve and organize data today. So private markets will, in my broader vision, at one point function similarly, not in the same efficiency level, but similarly to public markets, and firms that tackle this huge challenge will become enormously valuable because they will open up a universe of investments both to consumers as well as institutional investors that creates a very meaningful earlier stage and oftentimes more diversified investment universe than otherwise accessible.
Thanks so much, everyone. This has been really, really interesting. And yeah, I hope you enjoyed, everyone. Thanks.